Now is Gary Kaltbaum from Kaltbaum Capital Management. He's also Fox News contributor. Kimberly Foss from Empyrean Wealth Management and Eric Schiffer from Patriarch Equity. So, Gary, are you into the Kung Fu Panda stuff? Is DreamWorks for you?
Not really. I'm into the great relative strength companies with strong earnings and revenue growth, and this one really doesn't have it. They report losses 3 out of the 4 quarters a year, and they're based on a good movie versus not a good movie. It's an okay stock. I couldn't go any further than that, though.
All right, but Kimberly, they do have this affiliation now with Netflix, and Netflix is gold.
Yeah, absolutely, David. And, you know, since they didn't have a release since like March of this year, it's a little surprising that they actually came out with a positive earnings, which is a good thing. But, you know, I'm in the camp, too. It's like I can take the stock or leave it. It is in our small cap portfolio. But, you know, I wish them well. But we're just holding the stock at this point in time.
Boy, 2 non-takers. Eric, that leaves you.
I think it's terrible. I think it's a terrible stock. I think I agree with everyone here.
I'm just looking right now, by the way. I'm looking if you guys have tipped the scales. I don't see the stock going down anymore after hours. So, but go ahead.
I just don't like it. You know, it's not to me a viable investment. With all the different types of investments, why would anyone want to put their money in this company?
Gary?
Frankly, their best days are behind them.
Gary?
Yes.
Yeah, I know. Is there any way you'd buy into this stock? I mean, it is cheap, isn't it?
Yeah, but let me just say this. I use 2 words when I look at the market, and that's relative strength, and how is that stock performing versus the market. I want the stocks that are leading the markets up. If you look right now, it's a very big cap market. Facebook gaps up on earnings. Google, Amazon gap up on earnings. They're leading the markets. Those are the stocks I want to look for. I don't want a stock that's being drawn up by the market. It just doesn't make the grade for me.
Let me jump in here for a second as somebody who has actually consumed some of their products lately. I mean, they talk about their new offerings that are on Netflix. My kids have actually plowed through all of those. The series on Turbo they were watching yesterday, Mr. Peabody and Sherman, we were all over that last weekend, How to Train Your Pet Dragon. I mean, there's an endless need for content on Netflix, and the best thing you can do is have any tie to a character that kids already know. I mean, it does seem like that there is an opportunity for them right here because the kids consume stuff so fast on Netflix, they've got to keep buying content. Does this make this stock compelling to any of you on that front? Kimberly?
No, I mean, not really, because you can get it all over the place. You can buy DVDs, you can buy, you know, you can get content anywhere you want to.
Okay.
The thing is also, you know, money flows into where it's best rewarded, and obviously the markets are telling it's not rewarded.
We're going to put this thing out of its misery.
Here.
Let's go to Shake Shack. They're out with third quarter earnings. Liz McDonald has those. EMAC, what do you see?
Yeah, it's a beat. They're coming in at 10 cents a share. The expectation was 7 cents. Also beating on the top line, coming in at 53.3 million. The expectation was 47.5 million, and they're giving a 2016 revenue estimate of 237 million to 242 million. So Shake Shack coming in strong too on same-store sales growth, popping at 17%. The look-see there was 9.6%. So we're watching these shares basically possibly moving in the after hours. The bid-ask coming up. So we're going to be staying on Shake Shack. What is working for them is still the limited menu. The baby boomers are lining up. They're liking the limited menu. The kids don't have a lot of choices to ask from. And so, boy, those baby boomer parents, I know like you, Melissa, and David probably enjoy taking your kids there. They can only have a few limited choices. So, you know, it's an interesting thing with Shake Shack. They're probably going to talk about whether or not they're going to do an offering. That's what weighed on the last quarter's, results. But Shake Shack now, for a consecutive quarter since it went public in January, has been beating results. So we'll be watching these shares for you. Back to you guys.
No, I mean, that's a phenomenal beat. Let's bring our panel back in for reaction. As bored as you were with DreamWorks, it seems like you've got to be excited about this one. I mean, Gary, I thought when FactSet put out the idea that they were looking for same-store sales growth of 9.6%, that was ambitious. And here's Shake Shack just crushed that at 17%. What do you think about that?
I think there's definite potential here, but a couple of things. The burger industry now is more crowded than the Republican primaries. Everybody is open up hamburger joints, especially out in Orlando. It's on every corner. The other thing is valuation. It's trading at 250 times earnings. It's got a $2 billion market cap with just a couple of $100 million in revenues. I'm not so sure this is going to take off a lot. Maybe it goes higher from here, but I just think they came out with a too high valuation.
I hear you on valuation, but Kimberly, let me ask you. I mean, you say it's too crowded. You can't go to a Shake Shack and not wait online forever. I mean, the only reason why we don't go is because the line is so long, and it doesn't seem to impact it the more they open. I mean, they've got them open all over the city now. Still, the line is down the street and around the corner. It's a combination of a good burger that people perceive to be healthier. I don't know how a burger can ever be healthy, but it's organic, blah, blah, whatever. They serve alcohol. It's a fun experience for kids and for the parents. I mean, Kimberly, I don't know. I think this one sets itself apart.
I do think I agree with you, and you know what? We're Shake Shack virgins out here. You know, we're in California, so we're waiting for the LA Shake Shack to open, right, guys? So I actually think that there is room for potential for growth here, and I think it's really in their stores. They're opening one in Tokyo, they're opening one in Dallas, and of course we're still waiting out here for California. So you know, our equivalent is In-N-Out Burger. So I still think there's room for growth here, and we do own it in our portfolios as well.
Yeah. Eric, what do you think? The point of valuation, though, it is quite rich. I mean, we have seen this stock rocket higher. It has only been public since January. Another beat with this one. You got to think it's going to rocket higher today as well. Is it too rich?
Way too rich. To me, this is, from an investor standpoint, like a vegan burger. There's no real beef in terms of what they are able to really prove from a long-term story. We don't know. It's very speculative. And with that kind of valuation in an economy that we don't know what's going to happen, I wouldn't do it.
Yeah, and we showed that chart, which seemed to tell a different story. The stock had been a lot higher, but that was after a secondary offering. That's where you saw that slump there. So that's why we talk about it still being rich, even though it's lower. Guys, thank you so much, all three of you, for joining us.